Welcome to the deep dive. Today, we're going to be diving into the world of hedge funds.
Okay,
You've shared some sources with us,
great.
and we're going to be kind of untangling those sources, exploring how these investment vehicles work, and hopefully by the end, you're going to have a much better grasp of this corner of the financial world.
Yeah, these are alternative investments that can be pretty opaque.
Yeah, exactly. So let's just start with the basics.
Bro.
What are hedge funds? What makes them different from, say, just investing in the stock market?
Well, hedge funds pool money from accredited investors.
Hmm.
So you have to meet certain criteria to be able to invest.
Okay.
And they use a wider array of strategies than you'd find in traditional investments.
Okay.
And so that's what makes them different.
So it's like a bigger toolkit in a way.
Exactly. It's a toolkit with a lot more options. Yeah.
Okay, that makes sense. And you mentioned strategies. Our sources mention everything from long-short equity to something called global macro,
Right.
which sounds fascinating. Could you break down some of these common hedge fund strategies for us?
Sure. So long-short equity is basically a strategy where you're buying stock that you think are going to go up and you're selling short stocks that you think are going to go down.
Okay.
Global macro is a strategy that involves making bets on the direction of entire economies or markets.
Okay.
For example, a hedge fund manager might believe that the euro is going to weaken against the dollar,
Mm-hmm.
and they might place a bet accordingly.
So it's about making big bets on the direction of entire economies or markets.
That's right.
That sounds pretty high risk, high reward.
Well, it certainly can be, yeah.
Yeah.
And to manage those risks, hedge funds employ sophisticated risk management techniques.
Okay.
They try to align the risk profile with the strategy.
Yeah.
Of course, you can't eliminate risk entirely, but you can at least manage it intelligently.
Our sources mentioned something called the Sharpe ratio. How does that play into this whole risk versus reward idea in the hedge fund world?
The Sharpe ratio is a way to measure risk-adjusted returns. Imagine two funds, both with a 10% return. One fund achieved that with really high volatility. The other achieved it with relatively low volatility.
Okay.
The Sharpe ratio would be higher for the fund with the lower volatility
Okay, that makes sense.
because it achieved the same return with less risk.
So it's not just about how much money you make, but it's about how smoothly you make it right.
Yeah, exactly.
Okay, now let's talk about the structure of hedge funds. We read that they often operate as private partnerships.
Yes.
What does that mean for someone who might be considering investing in a hedge fund?
This structure provides flexibility in terms of investment strategies and regulatory requirements.
Okay.
However, it also limits access
Hmm.
because typically you'll see large minimum investments required, often in the millions of dollars.
Wow, so this is not for just anyone.
Yeah, you have to be an accredited investor to invest in a hedge fund.
Okay, and then there are the fees. Our sources mentioned the infamous 2 and 20 fee structure. What exactly does that entail, and why is it sometimes controversial?
Sure. So 2 and 20 refers to a traditional fee structure where hedge funds charge a 2% annual management fee and a 20% performance fee.
Okay.
So if a fund generates a 10% return, the managers would take 2% for managing the fund and an additional 2% as their performance fee.
Got it.
This structure is sometimes debated because critics argue those high fees can eat into investor returns.
Yeah, I can see why people would be a little bit hesitant about that.
Right.
So for investors, understanding both the fee structure and the risk profile is critical before you just jump right in.
Yeah, definitely.
Now, if you were advising someone considering investing in a hedge fund, what would you say are the essential things they need to know before they even think about handing over their money?
Well, I'd say due diligence is paramount.
What does that mean?
It means that you really need to do your homework.
Okay.
You wouldn't buy a house without a thorough inspection,
I
right?
don't know.
Same applies to investing in a hedge fund. You need to thoroughly analyze a fund's track record, understand their strategies in detail, vet the fund managers, and just make sure that you are comfortable with their investment philosophy and risk management approach.
So you're really saying be a detective, get in there, dig deep into the details.
Exactly right.
Now, our sources point to some interesting trends shaping the hedge fund landscape, particularly in 2023. What are some of the key developments that you think our listeners should be aware of?
Sure. One major development is the rise of ESG investing,
What is that?
environmental, social, and governance factors.
Okay.
And even hedge funds are feeling the pressure to incorporate those factors.
So even in this high-stakes world, there's a growing awareness of sustainability and responsible investing.
Absolutely. Investors are increasingly factoring in a company's environmental impact, social responsibility, and governance practices before making investment decisions.
It sounds like the world of hedge funds is changing. What else should we be paying attention to in terms of trends?
Another major force is technology. Specifically, artificial intelligence and machine learning and hedge funds are leveraging these tools to analyze vast amounts of data, identify patterns, and potentially make more informed investment decisions.
Wow. So it's not just about intuition anymore. It's about harnessing the power of data.
That's right. And this leads to another trend. The increasing demand for transparency and accountability. Investors want to know how these algorithms are being used, what data is being analyzed, and what safeguards are in place.
So it sounds like technology is really reshaping the hedge fund landscape, both in terms of how they operate and how they communicate with investors.
Yeah, definitely.
Okay, well, this has been a great overview of hedge funds, their strategies, the risks involved, and some of the key trends shaping the landscape. But we're just getting started.
Right.
In part 2 of our deep dive, we'll be delving into some real-world examples of hedge fund strategies, both successful and cautionary, to help illustrate these concepts we've discussed today. So stay tuned.
Sounds good.
Welcome back to the deep dive in part 1. We covered a lot of ground, from understanding what hedge funds are and the strategies they use to the risks involved and some key industry trends.
Yeah.
But now I think it's time to bring some of these abstract concepts to life with some real-world examples.
Yeah, definitely.
So is there a particular hedge fund strategy that stands out to you? Maybe one that has a captivating success story?
Sure.
Or even a cautionary tale that can help our listeners really grasp the potential and the perils of these strategies?
Well, there are many to choose from.
Okay.
But the story of George Soros and his quantum fund
Okay.
is a classic example of the global macro strategy in action.
Okay. George Soros, a name synonymous with hedge fund success.
Back in 1992,
Yeah.
Soros made a billion-dollar bet against the British pound.
Wow.
He believed that it was overvalued and would be forced to devalue.
This is the legendary Black Wednesday event, right?
Everyone.
Where he essentially broke the Bank of England.
Yes. Soros's quantum fund shorted the pound heavily, and when the currency was indeed forced to devalue the fund, reaped massive profits.
Wow.
This event really cemented Soros's reputation as a brilliant global macro investor
Okay.
and highlighted the potential of this strategy to make extraordinary gains by anticipating these major economic shifts.
So it's about identifying these macroeconomic imbalances and then making these bold bets on how they'll play out.
Exactly.
Wow. But it's not just about making the right call, is it? It's also about managing risk.
Right.
Even someone like George Soros, with his incredible track record, I'm sure has faced some setbacks along the way.
Oh, absolutely.
And those setbacks, I imagine, can be magnified when leverage is involved, right?
Yes. Leverage can amplify both gains and losses.
Exactly like we discussed earlier.
One well-known example of this is long-term capital management,
Okay.
or LTCM,
LTCM. Okay.
which employed highly sophisticated strategies but ultimately collapsed in 1998.
I've heard about LTCM. Yeah, it's considered a classic cautionary tale in the hedge fund world.
They used complex mathematical models and leveraged strategies to bet on bond spreads.
Okay.
And for a while, they generated extraordinary returns.
Uh-huh.
But their downfall came when the Russian government defaulted on its debt.
An event that no model could have predicted.
Precisely. This black swan event triggered a global financial crisis
Wow.
that sent shockwaves through markets.
Yeah.
LTCM's highly leveraged bets went sour, leading to massive losses that nearly brought down the entire financial system.
So even with brilliant minds and sophisticated models, hedge funds are not immune to risk.
Not at all.
That's a crucial lesson. No strategy is infallible.
Right.
And black swan events, those unpredictable, high-impact occurrences, can and do happen.
They do.
This underlines the importance of diversification,
Absolutely.
risk management, and really a deep understanding of the inherent uncertainties in financial markets.
Needs to be prepared for anything.
It's a reminder that the markets can be incredibly unpredictable.
Yes.
And even the best-laid plans can go awry.
Absolutely. And this brings us back to the importance of due diligence for potential investors.
Okay.
Understanding a fund strategy,
Yeah.
assessing the risks involved,
Yeah.
and carefully evaluating the experience and track record of the fund managers.
So it's about asking the tough questions.
Yes.
Understanding the potential downsides.
Right.
And not being seduced by the promises of these outsized returns.
Exactly.
It's easy to get caught up in the hype,
It is.
but you have to be level-headed and realistic about the potential risks.
Absolutely.
So while these real-world examples highlight the potential for these big gains,
Yes.
they also serve as a stark reminder of the risks involved.
That's right.
Now, perhaps we can shift gears a bit
Sure.
and talk about the future of hedge funds in part 1. We touched on some of the key trends shaping the industry, like the rise of ESG investing,
Yeah.
and the growing use of technology.
Right.
I'm curious to hear more about how those trends will continue to evolve and reshape the hedge fund landscape.
Well, one area that's particularly interesting is the intersection of technology and investing.
Okay.
The use of artificial intelligence and machine learning is already transforming how hedge funds operate.
You mentioned earlier that some funds are using algorithms to analyze vast amounts of data and make investment decisions.
Right.
Is that becoming more common?
Absolutely.
Mhm.
This approach, often called quantitative investing, or quant for short, is becoming increasingly prevalent.
Okay.
Hedge funds are leveraging algorithms to find patterns, exploit inefficiencies,
Uh-huh.
and execute trades at speeds that would be impossible for humans.
So it sounds like a high-tech arms race,
It is.
with funds constantly seeking an edge through algorithms and data analysis.
Exactly.
But how does this impact the average investor?
Well, for investors, it's important to understand how these algorithms work,
Okay.
what data they're using,
Uh-huh.
and what risks they might introduce.
Okay.
Just because a decision is made by a computer doesn't mean it's infallible.
Right. And I imagine there are ethical considerations here as well.
Yes.
Are there any concerns about bias being built into these algorithms,
Sure.
potentially impacting certain markets or groups of investors unfairly?
Those are valid concerns, and the industry is grappling with how to ensure fairness and transparency in the use of AI.
Okay.
It's crucial to have human oversight,
Yeah.
ethical guidelines, and ongoing monitoring to mitigate those potential biases and ensure that these technologies are being used responsibly.
So it's not just about the technology itself, it's about how it's developed, implemented, and governed.
Exactly.
Okay. And beyond AI, there's a whole range of technological innovations impacting the hedge fund landscape,
Yes.
from blockchain technology and cryptocurrencies
Right.
to the increasing use of alternative data sources,
Yes.
like social media sentiment analysis.
Yeah.
The industry is constantly evolving and adapting to these new technologies.
It's a fast-moving space.
It sounds like the pace of change is accelerating. What does this mean for investors who are trying to navigate this complex world?
For investors, it underscores the importance of staying informed, doing your due diligence, and working with advisors who understand these evolving technologies and the risks that they present.
So knowledge and expertise are more crucial than ever in this rapidly changing environment.
Absolutely.
What else should investors be thinking about as they look toward the future of hedge funds?
Well, another important development is the rise of retail investors
Okay.
entering the hedge fund space.
So these are not just the ultra-wealthy anymore.
Not necessarily. Traditionally, these funds were exclusive to accredited investors.
Right.
But we're seeing new platforms and structures emerging that allow everyday investors to participate.
So the barriers to entry are coming down.
To some extent, yes, this could democratize access to alternative investments.
Okay.
But it also raises concerns about investor protection and the potential for less sophisticated investors to take on risks they don't fully understand.
So it's a double-edged sword,
It is.
greater access to potentially high-return investments, but also the risk of investors being caught off guard by the complexity and volatility of these markets.
That's a good way to put it. And this leads to another key trend, the increasing demand for transparency and regulation.
Okay.
As more retail investors enter the space, the calls for greater oversight and investor protection are likely to grow louder.
So the future of hedge funds might involve a delicate balancing act,
It might.
maintaining the flexibility and innovation that have historically driven returns,
Yes.
while also addressing the need for greater transparency and regulation.
That's right. It's a dynamic and evolving landscape.
Right.
And the next few years will be crucial in determining how these trends play out and reshape the hedge fund industry.
Well, it sounds like the future of hedge funds will be shaped by the interplay of technology regulation and the changing investor landscape.
I think so.
But there's still more to explore. In part 3 of our deep dive, we'll wrap up our exploration of hedge funds, delving into some final provocative thoughts for you to ponder as you continue to navigate this complex and ever-evolving world. So stay tuned. Welcome back to the final part of our deep dive into the world of hedge funds. We've covered a lot of ground, from understanding the basics of hedge funds and the strategies they employ,
Right.
to exploring real-world examples and the key trends shaping the industry.
Yeah, we've also touched on some important considerations for investors, like the importance of due diligence transparency
Right.
and understanding the risks involved.
Exactly. But now I'm eager to shift our focus to the future. What's next for hedge funds?
Okay.
What should investors and anyone interested in the financial world be thinking about as we look ahead?
Well, the hedge fund industry is at a fascinating crossroads,
Okay.
with several forces converging that could dramatically reshape the landscape in the years to come.
So where do we even begin?
Hmm.
What are some of the most significant trends that you see on the horizon?
Well, one trend that's already having a profound impact,
Okay.
and that I think will only continue to grow in importance, is the convergence of finance and technology.
We talked early about how hedge funds are using AI machine learning to analyze data and make investment decisions. Is that what you're referring to?
That's a big part of it.
Okay.
But it goes beyond just AI.
Mm.
We're seeing the rise of blockchain technology, the growing influence of cryptocurrencies,
Uh-huh.
and the increasing use of alternative data sources, like social media sentiment analysis.
Okay.
All of these innovations are changing how hedge funds operate, how they manage risk,
Okay.
and how they interact with investors.
So it's not just about harnessing the power of data anymore. It's about embracing a whole new technological ecosystem.
Exactly. And this presents both opportunities and challenges for the industry.
Okay. How so?
On the one hand, technology can help hedge funds become more efficient, more innovative,
Uh-huh.
and potentially generate higher returns. But it also introduces new complexities, new risks, and new ethical considerations that need to be carefully managed.
It sounds like navigating this technological landscape will require a delicate balance
It will.
of embracing innovation while also mitigating potential risks. What else should we be paying attention to?
Another key trend to watch is the evolving regulatory environment.
Okay.
As the hedge fund industry grows and becomes more intertwined with the global financial system,
Uh-huh.
there's increasing scrutiny from regulators who are focused on investor protection and systemic stability.
So we might see more rules and regulations governing hedge funds in the future.
It's certainly possible, and how the industry responds to those regulations will be crucial.
In what way?
Will they embrace greater transparency and accountability, or will they resist efforts to rein them in?
Okay.
The answer to that question could have a significant impact on the industry's long-term prospects.
It's interesting to think about how the industry will adapt and evolve in response to these external pressures. What else should we be thinking about as we look toward the future?
One more trend that's worth mentioning is the changing investor landscape. We're seeing a growing number of younger investors,
Okay.
particularly millennials and Gen Z, who are more tech-savvy, more socially conscious,
Mm-hmm.
and more interested in alternative investments than previous generations.
So these younger investors are bringing a different set of values and expectations to the table.
Absolutely. They're more likely to demand transparency,
Okay.
to factor in ESG considerations, and to be comfortable with investing online and through mobile apps.
Interesting.
They're also more attuned to the risks of climate change and other global challenges, and they're looking for investments that align with their values.
It sounds like the hedge fund industry will need to adapt to meet the needs and expectations of this new generation of investors if they want to remain relevant.
Exactly. And this brings us back to the central question, what's next for hedge funds?
Yeah. What is next for hedge funds?
I think the answer lies in their ability to adapt, to innovate, and to embrace change.
So it's about more than just generating returns. It's about evolving with the times, responding to new technologies, embracing new values,
Right.
and building trust with a new generation of investors.
Precisely. The hedge funds that can successfully navigate these shifting sands will be the ones that thrive in the years to come.
Well, it's a fascinating and dynamic landscape.
It is.
And I'm sure we'll continue to see surprises and innovations in the world of hedge funds.
Absolutely. It's a world that's constantly evolving, and I encourage anyone interested in finance to keep exploring, keep learning, and keep asking questions.
Well, that's a great note to end on. Thank you so much for joining us on this deep dive into the world of hedge funds. We hope you've gained valuable insights and a deeper understanding of this complex and ever-changing industry.
It's been my pleasure.
That's it for this episode of The Deep Dive. We'll catch you next time.